A study by the FINRA Foundation found that a staggering 53% of investors couldn't answer basic financial literacy questions correctly. This isn't an intelligence problem, it's a signal problem. Investors are drowning in data, but starved for clarity. They believe analyzing a stock takes weeks of work, a finance degree, and 3 monitors. That is a myth. And today, we're going to debunk it. The difference between gambling and investing is a process. In the next 10 minutes, I will give you that process. A battle-tested, 5-point checklist that allows you to perform a foundational analysis on any stock in under 10 minutes. This framework will empower you to cut through the noise, make informed decisions, avoid catastrophic mistakes, and build your investment portfolio with the confidence of a professional. Before we get to the checklist, we must perform a critical mental shift. Stop thinking about buying a stock. Start thinking about buying a business. A stock ticker, AAPL, TSLA, GOOG, is not a lottery ticket. It is a legal certificate of partial ownership in a real operating business with employees, products, customers, and debt. Your goal as an investor is not to guess which direction a squiggly line will go. Your goal is to assess the health and value of the underlying business. This 5-point checklist is designed to do exactly that. It's a rapid diagnostic tool. Think of it as a doctor's initial exam. We're going to check the vital signs of a company before we even consider committing our capital. The first 2 points assess the business's character and competitive standing. The final 3 points dive into the hard numbers that reveal its true financial health. So, what is the first, most crucial financial metric you must check before investing a single dollar? This is the core of our system. You can find all the necessary data for free on sites like Yahoo Finance, Google Finance, or your broker's research portal. Point 1. The business model. Can you explain how this company makes money in one simple sentence? If you can't, it's a pass. Example. For Google, they sell highly targeted digital advertising. For Coca-Cola, they sell beverage concentrates and syrups to bottlers worldwide. Clarity is key. Complexity is where mistakes are made. Point 2. The economic moat. What is this company's sustainable competitive advantage? Why can't a competitor with a lot of money come in and crush them? Examples. Coca-Cola's moat is its brand, built over a century. Facebook's moat is its network effect. Everyone is on it because everyone is on it. A pharmaceutical company's moat might be its patents. Your goal is to identify this moat. Moat, no investment. Point 3. Financial health, the balance sheet. The key metric here is the debt-to-equity ratio. Theory. This ratio compares a company's total liabilities to its total shareholder equity. It's a direct measure of leverage and risk. A ratio above 2.0 suggests high risk. Analogy. Think of this as a person's personal financial health. A high debt-to-equity ratio is like having massive loans and credit card balances relative to your net worth. You might still be paying your bills, but any disruption to your income could be catastrophic. Just as a good credit score gives you financial flexibility, a low debt-to-equity ratio gives a company a buffer against bad times. Example, a software company like Microsoft has a low DE ratio, around 0.4. It's a fortress. An airline, which needs to borrow heavily for planes, might have a ratio of 4.0 or higher. Neither is inherently bad, but the airline is far more fragile in an economic downturn. Point 4. Profitability, the income statement. We measure this with net profit margin. Theory. This metric shows what percentage of revenue is left after all expenses have been paid. It's calculated as net income, revenue, 100. We look for high, stable, or increasing margins. Analogy. Imagine you own a grocery store that does 1 million in sales, revenue. After paying for the food, staff, rent, and taxes, you have $20,000 left. Net income. Your net profit margin is 2%. Now imagine you own a software business that also does $1 million in revenue. After its expenses, it has $300,000 left. Its margin is 30%. That software business is a far more efficient and powerful money-making machine. Example: look at the profit margin of Visa, over 50%, versus Walmart, around 2.5%. Both are great companies, but Visa's business model is fundamentally more profitable. Point 5. Valuation. Is it a fair price? The classic metric here is the price-to-earnings, PE ratio. Theory. The PE ratio tells you how much you're paying for $1 of the company's annual earnings. A PE of 20 means you're paying $20 for every $1 of profit. Analogy: buying a stock is like buying a small apartment building to rent out. The price you pay is the stock price. The annual profit from rent is the company's earnings. If the building costs $500,000 and generates $25,000 a year in profit, it has a PE of 20. It would take 20 years of profit to earn back your investment. Whether that's a good deal depends on the location, the industry, and if you expect rents to grow quickly. Context, like prevailing mortgage rates, is everything. Example: a mature, slow-growing utility company might have a PE of 12. A fast-growing tech company might have a PE of 50. The high PE implies investors expect massive future growth. Your job is to decide if that expectation is realistic. This checklist is a powerful filter, but investors often fall into two traps. Pitfall number 1. Analysis paralysis. Don't get lost in the weeds. The goal of this 10-minute check is not to know everything about the company. It's to know enough to avoid obvious mistakes and identify businesses that are worthy of deeper research. Use this checklist to say no quickly. Pitfall number 2. Forgetting the qualitative. Numbers tell you what happened in the past. They don't always predict the future. Is the management team exceptional? Is the industry in a long-term decline? The numbers can look great for a company selling DVDs, but we know how that story ends. The checklist must be combined with sound judgment. Avoiding these pitfalls is crucial for consistent success. But there is one more layer to this analysis: a pro-level check that most retail investors completely ignore. The advanced strategy: look beyond earnings and analyze free cash flow, FCF. Net income, the earnings, in the PE ratio, is an accounting metric. It can be manipulated through various accounting practices. Free cash flow is much simpler and harder to fake. It's the actual cash left in the company's bank account after it has paid for all its operations and capital expenditures. Think of it this way: earnings are the company's stated salary. Free cash flow is the actual money left in their checking account after all the bills and investments are paid. Which one gives you a truer picture of their financial health? This is the money a company can use to pay dividends, buy back shares, or acquire competitors. A business with strong and growing free cash flow is a healthy business. When a financial advisor or a professional wealth management firm analyzes a company, this is one of the first metrics they check. You should too. This is a dense session. Let's synthesize it into 3 core principles. Change your mindset. You're not buying a stock ticker, you are buying a piece of a business. Your analysis should reflect that. Use the 5-point checklist as your first filter. In minutes, you can assess the business model, the moat, the debt to equity, the profit margin, and the PE ratio to eliminate weak candidates. Follow the cash. For a more advanced and honest look at a company's health, go beyond accounting earnings and look for strong, consistent free cash flow. This process transforms you from a speculator into an analyst. It gives you a repeatable framework for intelligent decision-making. If this analysis provided you with real value, invest a single click in the subscribe button to get daily access to the Codex. Knowledge is the new capital. We'll see you tomorrow.